This is our Forex blog for October 9th, 2012. And the first step of our easy three-step Forex trading system is to simply look at the currency meter and determine which currencies are strongest to buy versus the weakest ones. And the best way to do that is use our sortable currency meter. Sort it from strongest to weakest. You can see the yen, dollar, pound, and CAD are the strongest. Euro, Swiss, and New Zealand are the weakest. The real-time trend strength is on the top. It's made up of multiple different tools, which you, in this particular version of Build Your Own Trend, you can set those weightings to whatever you want. Some of the tools measure the percentage of currencies, in this case the yen, going up or down versus the rest of them, and other ones such as ADX Trend, Momentum Pro, measure the intensity of that trend. So anytime it's at or above the 80 level, it means that basically 75 to 100% of yen pairs are going up or down, depending on if it's red or green, and it's also doing so with incredible intensity. And those trends tend to continue. Underneath that, we have the 15-minute trend, hourly, daily, weekly, monthly. Obviously, the more time frames that are up, the better. You can see the dollar pretty much from around 246. All the time frames are up. And usually when you have a lot of strength like this, followed by half an hour to an hour of weakness, that strength is going to resume, which it does, briefly here for an hour. Then you have a little bit of weakness, and then the strength resumes again. When all the longer time frame trends are up, sometimes you'll get a deeper pullback like this, and really as soon as the weakness subsides, somewhere around here, around 758, you can start looking for buys in the dollar. Now in this case, it took another half an hour before the strength returned, but you want to anticipate the strength returning. This is the best patterns are a lot of strength like this followed by very little weakness, usually half an hour to an hour of weakness. You're going to get intense strength again. In this case, it was a little different. It had a little bit of strength here for an hour, and then weakness for an hour, then you can see strength for a long time after that. Notice this right here, an hour and a half or so of strength, 15 minutes of weakness. You're anticipating the strength resuming, which it does for about an hour here, and that's how you use the currency meter to make money. Same exact pattern here with the euro. Lots of weakness, very little strength for half an hour. That weakness returns, and for a couple hours. And so let's just take a look at the euro dollar, selling it after around 9:30. So here's 9 o'clock. And basically, anytime you have a currency that's going down with a lot of weakness, typically you want to wait for a decent pullback up. Let's go ahead and show one of the secrets that I've found to finding very high probability trades. Simply go to Add Studies, put on the moving average, and this is not a normal moving average. It uses digital signal processing technology, which basically means it's very fast, and we use a very fast 5-period moving average, and we shift it 2 bars to the right. You can avoid a lot of the unnecessary losses by just simply waiting for a decent sized pullback. And this is the older FX trading signals that we have. I'm going to remove that and add the one I'm working on, which is a little bit higher winning percentage. And once the currency goes down, especially underneath the lower containment band, it's usually going to need at least 8 to 12 bar pullback before continuing. So basically, here's your first bar above the moving average, second, third, fourth, fifth, sixth, 7, 8, 9, 10. At this point, you can start looking for sells in this trend, and it's not always going to go your way immediately. And sometimes you have a loss or two before you catch the big move. And that's really the key to trading. Small losses, big wins. At this point, you're looking for sells. It goes down, comes back up. Really doesn't stop you out. You want to put the stop a few pips above the high. Comes down again. And you can see as it's going down right here, the weakness kind of falls off, and you have every opportunity to get out of this trade pretty much near break even. See if it can go a little higher and look for another counter trend trade maybe right here, or not counter trend trade right here. This sell signal right here is pretty high probability. And notice as it's going down, there's not a whole lot of weakness. So move your stop to break even. Worst case scenario is a break even. So you might have lost, let's say, 5-6 pips, broke even on that one. The third trade here, you can see it fell about 15 pips. And again, it fell with a little bit of weakness, but only for one bar with intensity. The previous trends were pretty much over the 80 level all the way down. So sometimes when a currency is not willing to go back initially, it's going to make a two-wave pullback. So draw your fibs on this first wave and really start looking to get short again somewhere between the first and second fib target. Now you can see it hit this fib target here and did pull back about 15 pips, came back up again, and you really want to wait for a close underneath the displaced moving average. So you might have went short right here, and you would have unfortunately had a small loss on that one. Went back up, touched the 20-day moving average and the 2.0 fib level on the first move. And as soon as the strength falls off, which is on this bar right here, you sell it when it goes 1 pip below there, and you end up catching 10, 20, 30, about 40 pip move. It only takes one nice trade like that. I mean, a lot of times trends start, you get a little bit of pullback, and then they continue. And there's no multi-wave pullback like this. And other times, you're going to get into some break-even trades or small losses, and you got to manage your trades. You got to wait once you're in the trade, see what happens. Look at this bar here. All right, some weakness comes in, a little bit more weakness. It's kind of going sideways. The weakness is falling off. And so if you were short this, let's get rid of all these lines actually and make it simpler. If you were short right here on this trade, when you see, and I'll make this a little thicker, when you see it coming down without that much weakness, move your stop down right above the bar's highs. And notice on this bar it starts coming down, there's a lot of weakness here, and then the weakness falls off again. You might want to move your stop down a little bit so you lock in some profit. Whether it's 10 pips, 12 pips, whatever, that'll get rid of usually 1 to 2 losses. And then you get into another trade here, lose 6 pips, get short again. Even if you get out right here, you made 25 pips or so, and that gets rid of up to 3 losses. And then if you held on to this for 40 pips, you're left with about 30, 35 pips of profit on that. Now if you shorted right here, notice it did come down. There's some weakness. And then this bar right here, it lost some of its weakness. So you put your stop above that high and you get out. This is one of those trades where after a small pullback, the trend does continue. And you want, at the very minimum, 6 bars above the displaced moving average to wait for a sell. 1, 2, 3, 4, 5, 6, 7, 8. 8 bars that closed above it. So this is a pretty high probability trade right here. Our signal is set to short. You put your stop right above the high by a pip or 2. And notice as it's coming down, there's not a whole lot of weakness. So if you want to get out of your trade here with a small win, that's up to you, or even break even. And at that point, guess what? The previous time it went up had a decent momentum on one bar. As it's kind of trying to go higher here, there's no strength. So you short it again when it breaks down here, and as it's falling, look what happens. A little bit of weakness here, kind of subsides a little bit. You can move your stop down, and then the weakness continues. Every time it's over the 80 level, just stick with the trade. Here's your first instance of the momentum down kind of subsiding. Put your stop a few pips above that bar's high. Notice we're underneath the lower containment band. We're starting to get some counter trend buy signals. This is typically where the trend's going to end, and I would move my stop above these bars high here, and I would have got stopped out at 92, short at around 20. So we made 28 pips on that while risking less than 10. And that's really the only key and secret to trading. Small losses, bigger wins. Let's look at the Swiss, and another perfect pattern. Lots of weakness. Pretty much all the time frames, longer time frames are down, except for the monthly trend, which is slightly up. You have about an hour here of just mild strength, and so let's just say as this strength starts falling off even more, at 10:45, we're looking to sell the Swiss. Now you want to sell it against one that's very weak. The yen looks very strong at that time, and also the dollar. So we're looking to buy the dollar versus the Swiss coming up to 11. Let's move this thing over. So this one is above the hourly. It spent 2 times going up, and it really has a double top right here. Typically double tops, if that's the end of the move, you're going to get a decent sized pullback. This one came down, found support, the 10-day moving average right here, and went sideways. There's really two methods that we look for entries into trades: pullback trades and sideways rectangle trades. Anytime it goes sideways for 30 minutes, and my preference is hour and a half to 2 hours, this one pretty much started going sideways right here at 9:43, and it broke out up pretty much an hour later. So that's plenty of time to go sideways. If anybody wanted to sell this, they would have. They had an hour to sell it. The trend's up. There's no, initially there's a little bit of weakness right here, and the weakness falls off. Anytime you see big moves up with a lot of strength and pullbacks or sideways moves with very little weakness, typically that trend continues. And you want to draw your fibs on there to get an idea of where your profit target is. Notice if you would have bought this at 93.70 breakout with 94.07 as your profit target, you made 37 pips while risking less than 10. And again, if you put your stop a few pips underneath these lows right here, this is pretty much what your risk is, plus or minus 2 or 3 pips. And if, in this case it did, but you never know if it's going to or not, if it hits your profit target, this is your profit. Now notice how much bigger the profit is versus the risk. In this case it's about 2.2, 2.3, maybe even 2.5 times bigger if the trade goes there than what your risk is. And that's the key. And that's the beautiful thing about trading too. You don't have to even be right half the time to make money trading. Some days I'm right 35, 40% of the time. I have a lot of break-evens, and that's one of the things that lowers my winning percentage. For instance, let's see a trade that I would have taken that would have been break-even on part of. This pullback right here, a lot of strength on the way up, a little bit of a pullback. This would have actually been a tiny loss. I probably would have taken it here because it had enough time to pull back, found support, a major support area where above the previous day's high. I would have probably got sucked into this trade in all honesty, and I would have lost 8 or 9 pips. And then usually for myself, I like to get my losses back. So if I took this next pullback trade right here with some buy signals, as this thing starts going up, right? Look, there's a lot of strength, the strength falls off. I'm going to try to get out of my trade probably right here at 65. And at 60, I probably lost 8 pips on the first one, made 5 on this one. I'm down 3 pips. Pulls back to the hourly moving average, which is a frequently high probability place to buy. And this point right here is the first sign on this bar right here that not that much strength, or not that much weakness. I'm going to buy when it goes above that bar, which it does here. And my stop is right underneath the lows here by a few, pip or two. And as it starts going sideways and going down with a lot of weakness, I'm a little nervous. As soon as this thing starts going up, I'm going to move my stop to break even. A lot of times hourly moving average trades work, but not always. And you can see on this one, it goes up, hits the upper containment band. This is the first sign of lack of extreme strength. It's at the lower upper band here, so I'm going to get out of this trade somewhere at 78 and at 52. 25 pip win while risking, 7 or 8 pips. And that's the key to trading. If you take all these high probability trades with low risk, you're going to, especially on good days like this, have wins that are 3 to 4 times bigger than what you're risking. Move your stop to break even after it goes 6 or 7, or I should say 2 different things. Let's say you start off with a 10 pip stop. As soon as it starts going up 5, 6 pips, move your stop in half. All right, there's no need, if it only goes up a few pips and then comes back down, there's no need to take your full loss. That's the first thing. Second thing is, once it goes, I'd say 10 or 12 pips, move your stop to break even. At that point, you have a risk-free trade. And sometimes if it stalls at a major resistance area and goes sideways, I will exit half my trade, and then my second half of the trade at the trailing stop, or as soon as the momentum ends. Myself personally, I like 20 plus pip wins. I'm happy. I don't care if it goes 50 or 100 pips after I get out. If I catch 20 pips on part of my trade, I'm very happy. So if this thing goes up 20 pips or more and I see the momentum stalling out, I'm going to pretty much put my stop right underneath that bar's low and get out of the whole thing there. And at that point, I'm hoping it pulls back and allows me to buy again. Sometimes it just kind of goes sideways right after stopping me out with a nice profit, and it shoots up again 30, 40 pips without me in it. You can't get upset about that because that makes you do stupid things. And I've learned from and had many thousands of dollars of losses taking trades out of revenge to try to get, perceived lack of profits back. Let's say I would have made another 1,500 on those extra 40 pips. Well, I want that 1,500. I shouldn't have got out. The market continued. I want that money. You can't think that way. Be happy with whatever your minimum goal is, and go on to the next trade. So let's look for one more example here. The New Zealand's longer time frame trend is mixed, but it starts pretty much on all time frames here at 10:30, showing weakness, not nearly as much as the Swiss or the Euro. But let's take a look at the New Zealand versus the yen, which is very strong on that time frame. You want to sell the weak New Zealand versus the strong yen. So let's look at this currency here. It's stuck between tons of Fibonacci profit targets and retracement areas. It's kind of mixed when it comes to what direction it's going to go in. Really, the only way to trade that is just kind of buy or sell breakout of that multi-hour sideways range. It's sideways from around 4 to over past 10 o'clock. So 6 hours of really 15 to 20 pip range. When it breaks out right here, you can go short. Typically, currencies that go sideways that long will make at least a two-wave move down. If you draw your fibs on here, 63.78 is your profit target. But it came down to the lower band, almost to the pip, and never went to the profit target. So if you miss this initial breakout, you have a little bit of a pullback here, 2-bar pullback. Notice that last bar up right here has almost no strength at all. Visually, it's about 20% compared to the weakness. Typically, those are pretty profitable trades. You're short, it goes down about 15 pips, and this is the first bar without that much. It's a little bit of weakness. Put your stop right above there, and you get out of this trade here at 90. You would have been short around 98 with a very small profit. Sometimes you only make 6 or 8 pips. But they can add up. If you have 3 6-pip moves, it's 18 pips. Let's say you took an 8-pip loss. You're up 10 pips. You catch a 20-pip win. You have a 28-pip day. That's wonderful. You only need 50 pips per week, 200 per month to double your account every 2 months. So think of that next time you want to put someone down for catching 6 or 10-pip moves. It all adds up. Don't be upset or shake your fist at any 6-pip win. It might just be the win that gets rid of a trade that doesn't pan out where you have a 6-pip loss. Now you break even. It's much easier to pull the trigger again when you break even versus being down 10 pips or 6 pips or 8 pips. So think of it that way as well.